Welcome back to another episode of Cash Flow Positive. I am here with Brian Bockholdt from Alliant Credit Union, and we are going to be talking about how to scale your STR portfolio using specific types of financing. It's important you know your options. So before I dive into this stuff and start asking Brian a ton of questions, Brian, introduce us, tell you who you are, tell us your background. Yeah.
Sure. Thanks, Kenny. Thanks for having me. My name is Brian Bockholdt. I'm with Alliant Credit Union. As Kenny pointed out already, I have been in the mortgage business for 30 years. I have to make sure I tell you my age. I'm only 48. When I say 30 years, it makes me sound a heck of a lot older than I actually am. I mean, I know I'm old, but 30 just makes me sound ancient. So it's pretty much all I've been doing my whole adult life is mortgages. And about 5 years ago, around the COVID time, I also became an STR investor myself. And we are up to, I think, 6 properties at this point. A few years back, kind of in the middle of that transition, my lending focus really started to change as I got to meet people like a lot of the people that are going to be watching this video and people like Kenny. My focus as a lender began to change. So for the last few years, I've been probably 70-80% of my business has been helping people buy short-term rentals.
Great. That's awesome, man. And so, Brian, I didn't tell you this. This is going to be on YouTube, and so occasionally, I'll make a visual joke. So, for those of you listening, you need to go check out the video on YouTube that we're going to post on this. But, Brian, I got to ask you, okay? Do you get a lot of Iron Man references, like Tony Stark stuff? Like people are like, "You look like Tony Stark."
No,
No. Okay.
Thank you. I must be having a good day.
Yeah,
I don't get that.
I'm like, I call Brian, like Brian probably
though.
doesn't know this, but like
I'm
I
cool
call
if we
Brian the
started.
Iron Man of the lending world. He
Yeah.
looks like,
Hey.
So it's a
I mean,
compliment. It's a compliment, but
I appreciate
anyway,
it. Yeah.
Brian,
If
yeah,
people want
Brian,
to start calling me that, I'm fine.
yeah.
I'll be. I will not complain.
Awesome, man. Well, all right, let's get down to business. Let's talk about lending and I mean,
Yeah.
we were talking about this before the show. I think this was actually a really good conversation. I did an interview with you during COVID. It was a while ago. And we talked about a lot about misconceptions. And that's kind of where I want to start with first.
Sure.
So you do a lot of second home lending loans, and there's a lot out there. So let's talk about that. What is that? Because a lot of people listening might not understand what differences are in the different types of loans. So
Sure.
give us a brief overview of there.
Yeah. Well, there aren't many misconceptions associated with second home loans, that's for sure. One of the big ones is that you can't rent the property, which is obviously not the case. The underwriting guideline put forth by Fannie Mae literally reads that the buyer will utilize the property for personal use. And here's the great part: some portion of the year. That's literally how vague it is. It's kind of vague on purpose. Some lenders have adopted this 2-week thing. You'll hear that out there. It's not necessarily even the case. And also, it's a completely immeasurable thing anyways. No lender is tracking you to see how many. You're not calling your lender to check in to make sure, hey, we just got here. We'll be here for 2 weeks and we're going to satisfy it. It doesn't work that way. The real distinction between the second home loan and an investment property loan is that when you're using a second home loan product, you're not able to use any of the projected rental income from the property you're buying to help you qualify for the purchase of it. That's the main distinction from a qualification perspective. Okay, so if you have the income to carry the new debt of that property, you're well on your way to qualifying for a second home loan. One of the big benefits to the second home loan product is the overall lending terms, most notably the 10% down.
Gotcha.
Compared to investment, which is going to start at 15% down and with far worse lending terms.
Is that the biggest reason why people want to do second home loans? If you can't use the income, what's the benefit?
Yeah.
Why would you do a second home loan?
Well, the reason that people want to use a second home loan is for the low down payment. Most people that are doing this are planning to scale or already scaling. Even the people buying their first one, their idea is if it goes well, they're going to do it again. And the main, the main barrier for most people is capital. It's having that $50,000, $60,000, $100,000 or whatever it is you need for that particular transaction, and then to be able to repeat that over and over. So usually it's capital that people run out of first, even before debt ratio in a lot of cases. So that would be the main thing there. I mean, it's down payment and interest rate and fees. I have a second home loan product. Not many do. That not only allows you to put down 10%, most have that, but the standard product that's out there right now for second home loans is going to include points. Points are, they're going to include on average probably 2 points or so, and they're also going to be a higher interest rate. Point is 1% of your loan amount. So if you're borrowing $500,000, a point is $5,000. If you're paying 2 points, that's $10,000. And so that makes the deal a lot less attractive. It can be difficult enough in this market with, house prices not necessarily having come down very much, if at all. And with interest rates, at or near a 23-year high, you throw an extra $10,000 in fees on there, it makes the deal a little harder to pencil. So we have a product where you can get a rate that's very competitive on a jumbo loan. We can get you in the high sixes. On a non-jumbo loan, get in the very low sevens, and you're not paying any points. And that's really the main attraction. That's what's keeping me so busy.
Let's dissect all of what there's 3 things I want to pick apart here, because you're basically saying, and this is huge, everybody listening to this, cash flow. I mean, the name of the podcast, Cash Flow Positive, right? Like, so if we want to cash flow, by decreasing the amount of debt service that we have is how we increase cash. If you don't understand that, go back to the first episode. I'm not talking to you, Brian, you get this, but like people listening, go back to the first episode. I talked about cash on cash versus cash flow. So decreasing the amount of debt that we have gets us higher cash flow, which means that if we decrease our interest rate, have a better rate, therefore we'll have, less monthly payments, and we'll increase our cash flow. So that's huge. That you are in, as of this is almost the middle of June, and you're in the 6s for your interest rates, and everybody else is in the mid 7s and 8s, even
in the 8s most of the time. Yeah. So that Fannie product that I referenced right now, which is really, if you call 10 lenders, it's probably what all 10, if not at least 9, would quote you, because it's all that they would have. So we have that product too. I can give somebody a 10% down Fannie Mae loan, 30-year fixed, 8.125% rate, paying somewhere around 2 points. And that's what most lenders will quote you.
So I want to make sure that people understand what the points are. So points, fees. Do you have another definition you'd like to explain to people what points are?
A point is 1% of your loan amount. A fee charged by the lender, 1 point equals 1% of your loan amount. So $500,000 would equal $5,000. And on that product, you're going to pay about 2. So that's $10,000 on a $500,000 loan amount. So obviously it's pretty significant. And the rate's about a 4% higher too. So that obviously impacts your cash flow. It impacts even your lendability on how much you can qualify for, all kinds of things. So matter of fact, I don't think I mentioned, a lot of people, not that everybody who watches this is going to know who I am, but a few might know who I am. I have been with Huntington Bank for the last 8 years, and I just recently transitioned here a few weeks ago to Alliant Credit Union. And I did that for a couple very specific reasons. And one of those is to be back open in business in every state except for Maryland and Alaska. Okay.
Darn.
And what's that?
Is it darn? All the STR deals in Maryland and Alaska. So.
Yeah, I mean, don't get a lot of definitely don't get a lot of Alaska requests. I think I've had one Maryland person I had to turn away, but the other thing was the ability to have this portfolio product that will allow me to do only 10% down up to $1 million loan amount with, again, rates either in the high 6s or the low 7s while charging 0 points. So we can go up to about 1.1 million on purchase price and still do 10% down.
Wow. Okay. So, and you kind of talked about this a little earlier. I want to break it down for people because it's confusing. What is a jumbo versus a non-jumbo loan, and why is there a difference?
Yeah. Well, jumbo loan limit presently, and it changes every year, goes up basically every year. As house prices go up, they raise the jumbo limit annually. But today it's $766,000, $766,550. That is the jumbo. So if you are borrowing, not purchase price, but if your loan amount is higher than that, you are getting a jumbo loan. That's really the only difference. This portfolio product is the same either way. The rate is a little lower on the jumbo, high 6s versus low 7s. But other than that, there are no differences.
So if you go beyond, basically what you're saying is if you do a jumbo loan, which is over the $766,000, the interest rate's lower.
It's actually a little lower. And our product for the jumbo 10% down does not have PMI. Whereas if you are not buying jumbo, there would be PMI. Now that PMI on a $500,000 loan amount might be $100 a month, $120 a month. It's not a big number, but it's still another small advantage to the jumbo.
Yeah.
I tell people if you're teetering right at that line, it's something to consider. Not sure it's worthy of changing your whole plan, to get a quarter lower rate and save $100 a month in PMI, but it's worth knowing.
That's interesting. Why is that though? Why don't you pay PMI on the larger?
That's just how it's not always like that. It wasn't like that at my previous place. There was PMI on whether it was a jumbo or a non-jumbo. So that's really just a lender discretion thing when they develop the product, how they decided to do it. It can be more difficult to find PMI providers for certain size of jumbo loans. A lot of PMI providers will only go up to like $1 million or so. So some lenders, not all, but some lenders for their jumbo, they just make it a rule that they don't charge PMI.
Gotcha. Okay, that's really interesting. And everyone listening to this, I mean, these are the things, like these are the little things. It's not just about necessarily focusing on just revenue, maximizing your STR revenue. It's what other levers can I pull? And these interest rates, these fees or points or, all these little things, these are things that you can adjust to increase your cash flow. I love that. So Brian, tell us, okay, so we know you offer really good interest rates, the PMI thing we talked about. Anything else with your bank that you love about your product? Because it's not true a traditional one, right? Truly traditional Fannie Mae second home.
Right. We have that product, but we don't use it because our portfolio product is substantially better. But we do investment property loans too. So there's really 3 loans out there that people are getting in this space. And one would be the second home loan, 10% down that we just talked about. The next would be a standard Fannie Mae, Freddie Mac type of investment property loan, which start at 15% down. And then there are the commercial type loans like DSCR, okay, which is not something I offer. But we do offer the 15% down investment property loan as well. You are going to see a difference in product and pricing or in pricing. You are talking about that 8% rate. You're talking about paying maybe 1.5 or something like that on those. So again, that's why people really want to try to qualify for the second home loan when they can. We always start there.
Now that investment loan you're talking about, is that where you can use the income of the short-term rental?
Sure. So yes and no. You're still using your overall debt ratio. Okay, we're not just looking at the property like on a DSCR. Mm-hmm. So we are with the investment property loan. So now it's like the middle of the 3 options. We are going to when the real estate appraiser goes out there to do the appraisal, they will look at rental comps in the area and they will assess a rental value monthly, and that number we get to introduce as income into your debt ratio. So that helps put a lot of people over the top. A lot of this is a process for people as they scale, depending on, how fast they're scaling, how big of properties or how expensive of properties they're buying, obviously what their income is. But a lot of times people will come to me looking for their first STR. It's probably still about half my client base, even though I got tons of repeat people or people that already own several. The people looking to buy their first, if they've got strong income, they'll usually qualify for that 10% down second home loan. The people with really strong income might qualify for it a second and even a third time before they have to pivot to something different. That initial first pivot is usually going to be that 15% down investment property loan, because maybe you've already bought 1 or 2 using the second home loan. Okay. And if you're scaling quickly, maybe a full year of rent hasn't hit your tax return yet for those. So you've depleted your DTI at least temporarily. So that 15% down would be the next step usually. And then again, if you're scaling really fast, you might be moving on to DSCR for the one after that. So that's kind of the standard process and kind of waterfall of loan products that most people are going to go through.
You alluded to this a second ago, and I just want to make this clear because there's a lot of misconceptions with at what point can your rental income from the property that you're going to acquire, can you use that to supplement your DTR, debt to income ratio?
Well, so I think I know what you had just asked me. If you're talking about as you scale, once that rental income from that second home that you bought, whether you use a second home loan to buy it or an investment property loan to buy it, regardless, once that income hits a tax return, okay, once that's on your Schedule E and that's where you want it, then the lender can use that rental income. Okay, let's say you close on a property like right now in June, and you get it active in July or August. When you file taxes next year, you're only going to have a few months worth of rental income, right? So it might not help you a whole bunch on that next tax return. It's going to be a partial year. So you might, in that event, have to wait until, you have a full year of service. Potentially, everyone's situation is different, but we wouldn't look at your monthly, like, okay, in September, they made this. They're going to look at it, your total income, and it's going to be divided by 12. So that's obviously the full year of service is going to help you much more. So, as you scale, you can bring that debt ratio back, right? So once
Okay.
you might go through that process that I just talked about, where your second home loan, maybe your second home loan again, and then your investment property loan, you run out of DTI, you do a DSCR, depending on how quickly you're scaling, but then you get all those properties on a tax return, okay? Now you may be able to go right back to doing a second home loan again, because now you have all the income to show from those properties. And that's the process that a lot of people are going through.
That's interesting. And I think a mistake that people make is they assume that, at a certain point, you can only do this like once or twice and then you're done and you never can come back to it. It's always DSCR or partnering with other people. And it just never is
definitely not.
Yeah, it's kind of short-sighted. And I think that's really important. Like you can kind of map these things out as you scale. Like if you're like,
absolutely, we have those conversations all the time with people. There's a lot of times that, that's usually they want to know. A lot of people, the smart ones, they want to know, how do I best do this over the next couple of years? My plan or my hope is to buy 3 or 4, and how do I do that? So we have those conversations all the time. One other thing, just real quick on the tax return, is when you do put that on your Schedule E, you're going to have your gross for the year at the top. So it was $100,000 or so. And then you're going to have all kinds of deductions from there. Your bottom line is going to look completely different than the gross on top. A lot of people are doing cost segs. So they're depreciating everything all at once, which creates a huge loss. But the good news is we can add back in a lot of those deductions, and the depreciation, whether it be natural depreciation or the full-blown cost seg, we can add all that back in. We can add back in your mortgage interest that you paid through the year, your homeowner's insurance that you paid, your real estate taxes that you paid. So your real income is not at the top or the bottom. It's, somewhere in the middle after we add those items back in.
Yeah, this is why I think that everyone listening to this, if you're going to go buy a short-term rental, you need to call Brian. So like there's a lot of lenders out there, Brian. Like I'll get on conversations with people and they've already had conversations with their lender from Bank of America or like wherever, and you're like, they're not counting this stuff. They're not looking at, oh, you took a cost seg or you took depreciation on your asset, like counting that back in, or those, like that's the kind of stuff you've got to work with. If you're going to scale an STR portfolio, you need to work with people who focus on STR loans on the financing side. I can't preach that hard enough. I think that is huge, because your DTI could vary from each different bank's perspective. No
doubt about it. You'd be surprised. I mean, you really would be surprised. It should be the same everywhere, and an income calc should be the same with any lender, but it's not always that way. We like to say the same thing can be with appraisals sometimes. I could send 10 different appraisers out to a house to do an appraisal. I might get 10 different values. So the same can be true. It shouldn't. Sometimes it's not, but it can be true with income calculation. There's no doubt it's a very specialized, portion of lending. And I think a lot of people are starting to realize that, though. I mean, I get a lot of people that come to me and they'll say, like, hey, we've got a guy we've always used for 20 years or 30 years, but we really thought we needed to, someone with a special, that specialized in this type of lending. And there's no doubt there's real value there.
I agree. So anyway, definitely, which Brian I'll put your info up here so people, if who are interested in contacting him, can get a hold of him and talk about products. But let's keep this conversation going, because I think it's been really productive, like a lot, very, very insightful, because I hear a lot of people when I first got started investing. I heard a lot of people talk about, like, well, you don't want to paint yourself in a corner, with your DTI, and you want to, like, do all, like, you got to be careful, and you
Yeah.
need to do these commercial loans. Like, what do you say to that?
I disagree with that completely. Your debt ratio doesn't do you any good if you don't use it.
Yep.
So unless you have something else that you want to use it for that's more important, then fine. If you're planning a new primary residence purchase and you're going to maybe significantly be elevating your home, or you're going to be buying something more expensive, then definitely take that into account, and maybe that does mean you go get a DSCR for your next rental property. But if you don't use your debt ratio, it doesn't do you any good. Having debt ratio freed up opens the doors to much superior lending products, and I think you're kind of foolish not to utilize that. So, and again, you're only really giving up your debt ratio temporarily anyways.
Mm-hmm.
If these properties perform and can carry their own weight, once they hit a tax return, you've now recouped that debt ratio.
That's huge too. A lot of people. That's why having these conversations. This is to everyone. Having conversations with these lenders who understand this concept, because you're sitting there thinking. A lot of people think sequentially. Like, I need to do this, then I need to do, like, I need to buy, like, I want to buy a primary residence. I might do in the next year or two, and then I'm going to buy an STR after that, and then I'm going to do this, and it's like, you're not going to scale that way. You know what I mean? Like, it's going to take years and years and years. It's just not how it's done. Obviously, this isn't a Dave Ramsey talk. Like,
No,
we're not. Yeah, Dave's
no.
like, put 30 down or whatever, or 50
Yeah.
down, like, buy a shack. But that,
You're not going to scale. You won't scale too fast if your main resource for finances is Dave Ramsey. That's for sure. So,
right.
to each their own. But yeah,
That's
yeah.
funny. But
Leverage can be your friend.
yeah,
So.
exactly. And I think it just starts with knowing what options you have in the conversations. I want to go back to something that's shocking for a lot of, this is weird. I don't know if you've seen this too from people, but when you tell them the 10% down loan product you have has a lower interest rate than the investment loan products at a higher down payment, are people shocked?
Yeah, maybe. I mean, I don't know if shocked's the right word, but people do
Or
need to be
surprised?
educated on it. A lot of people
Yeah.
are definitely not aware of it. But, again, a lot of people just don't understand the definition of second home. I'll have people that will come to me that don't own a primary yet. This is actually becoming a very popular thing to do. I've noticed it even mostly with, like, the people of, like, the millennials.
Mm-hmm.
They won't buy a primary residence for their first property. They'll buy an investment property, whether it be long-term or short-term. They'll buy an investment property. But a lot of people just don't really know what a second home is. So what these people were meant to say was, so they don't own a home. So they'll come to me and be like, well, how can I get a second home loan when I don't own a first one? It's not meant to be literal. Second home, AKA vacation home, AKA short-term rental. It's all really the same thing. So yeah, there are definitely a lot of misconceptions out there. That's for sure.
Yeah, that's I have heard a lot of people recently, millennials, like you were saying, going for
Yep.
the second
Very
home without
popular.
having the primary, and
Yep.
so that's
Yep.
one way. A random question. So, what if somebody there are going to be people listening to this who have loans they got that they're high interest rate, like we're talking 8%, in the eights. Maybe they did the DSCR, and maybe their DTI has improved over time because they have the income on the property and so on.
Yeah.
What refinance options do you guys offer?
So the refinance options really are going to look the same, and I'm glad you asked that question. That's a great question. Love to start. Hopefully, rates are going to tick down just a little bit more, and we're really going to, push the refi button with a lot of people. But the refinance stuff is going to look the same as the purchase stuff. You can still do the 10% down. The rates are the same. There's not going to be any difference, unless you're trying to do a cash out refinance. So if you're only paying off the balance of the mortgage, and you can roll in the couple $1,000s worth of closing costs as well. But if that's all you're doing, then that's the standard refinance, what's called a rate and term refinance. But if you want to pull $50K cash out or $100K cash out, then it's a cash out refinance, and that will change. the lending terms pretty significantly. On a second home, your maximum for a cash out is only 75% loan to value, where on a rate and term is 90.
Gotcha. Okay, so
So
with the cash out, what other? So obviously 75, you only get 75% of that, so you have to have 25% of equity into the property. But what other are there different terms for? Is it same rates, same? Yeah.
there is, for the cash out refinances, you're going to find a very tiny rate adjustment, so maybe 1/8% or something like that. So basically, it's going to be in the same ballpark as the purchase rates will be. The fees are all the same. We don't charge on our second home stuff. We don't charge points. Our lender fees are $1,200. It's going to be the same whether it's a purchase or a refi, or a cash out refi versus a non cash out refi.
Okay.
So this loan to value is the main differentiator there.
Are any of your products arms? Do you offer any more arms? I know that when you switch,
Oh yeah.
yeah. So
Yeah,
let's
yeah,
talk about that for a second too, because that's
yeah.
a big one as well.
Sure. And that's what I mean, and quite frankly, and I'm glad you brought this up too. That's what I'm quoting. Okay. We do have 30-year fixed options, but the rate in the sixes is a 5-year arm. So just maybe I can go through that here real quickly. And again, these rates, by the time people listen to this, could be different. And then when they listen to it 2 months later, who knows? But these are just based off today's date. A 5-year arm jumbo loan, 6.875%. 7-year arm, 7%. A 10-year arm, 7.125%. We do offer a 30-year fix for the jumbo. It jumps a quarter from there to 7.375%. But nobody wants the 30-year fix today.
Right.
Everybody's taking the 5 or the 7-year arm. Some people the 10. My hardcore 30-year fix people, I've never had an arm before. That terrifies me. They take the 10-year arm. But nobody's taking the 30-year fixed option because we're sitting at about a 23-year high in interest rates. So if we go, and for people, and just real quick for the people that don't know, a 5-year arm is a 30-year mortgage where the interest rate is fixed for the first 5 years. These are not, some people come in not even realizing that there's any fixed term. They just think an arm means it can adjust anytime it wants. So you still get plenty of fixed years on the front end. And I like to tell people, if we go 5, 7, or 10 years and you don't find a single solitary decent refinance opportunity, we probably got way bigger problems than your adjustable rate at that point.
Also, it's important to know that most short-term rental owners own their properties for only 3 to 5 years on average. So, and as you scale, it's not about doors, it's about the quality of the doors. And so if you're getting going and you're trying to scale and grow a portfolio, the reality is the chance of you owning this property, first or even second property, more than 3 to 5 years, even 7 years, the probability that's really slim or low. So it can be extremely advantageous. Especially if you know that it's an appreciating market, if it's a vacation rental market, and you're going to have that equity naturally built up over time. So yeah, all of that.
Now, when rates are back, if rates get back into 3s, then you'll want the 30-year fix.
Right.
You might not want the arm if they're in the 3s, but in the 6s or the 7s, or you're probably going to want the arm.
Yeah, and this goes back to, once again, name of the podcast, cash flow positive. We're trying to maximize our cash flow, not minimize cash flow to protect to mitigate some of the long-term risk we're kind of looking at, which is actually kind of low anyway. But anyway, this isn't a Dave Ramsey conversation. So if you're sensitive to that, then that's something to keep in mind. But we are all about these properties, maximizing the revenue out of them, but pulling other levers that can give us higher cash flow as well, which is, lowering expenses through the right types of loans. So it's crazy how a better interest rate can impact a deal, like thousands of dollars. It's not just a little bit, like a point, like a whole point of an interest rate is a huge deal in this industry. Thoughts on that?
It is. And in fact, I don't want to get in trouble here, but
let's get in trouble, man.
Listen, rates are what they are now, and you cannot count on them going down. You can't plan. You have to be prepared you have to have a deal that works at the rates as they are currently, situated. Right. But when I'm underwriting for my next deal, I'm still looking at what my payment's going to be when I'm able to refinance it down to 6 or 5 or 4%. I'm not counting on that.
Right.
Okay. I'm making it work at the 7, but if you play around with that, and you look at how substantially your payment drops, I can forecast a little bit, because a lot of people out there right now, again, prices still pretty high, but don't wait. I don't necessarily recommend you wait for the prices to come down. I know people that are still waiting from 10 years ago, and they've just disappeared out of the market now because prices have tripled, and they're like, oh, I'll never, I wouldn't wait for that. That's for sure. But no, I think it's reasonable to project a little bit and to see what my payment might look like when rates come down a little bit. You definitely shouldn't count on it. That would be dangerous. Yes. But in this market, a lot of people are happy right now to find a deal that just pencils, that is going to, using conservative numbers, if they can turn a profit, they're in. It doesn't have to be, that's not people aren't necessarily looking for, they're looking for it. And if they find it, obviously they're snatching it up, but, they're not necessarily dead set on this, specific number per year right now. They want one that has positive cash flow, and they keeping in mind that you have an appreciating asset, right? So you're not necessarily counting that, but that's property over time is going to increase in value. So that's income. And you're also paying down a mortgage. So you're going down on the mortgage, up on the value. So that's why, even if you're only cash flowing $1,000 a month, for a lot of people in this market, that's good enough to get in.
Yeah, I absolutely love that. So, Brian, as we wrap up here, so first off, how can people get in contact with you?
Well, I think you're going to drop my credentials, but just call my cell phone. And then the phone number is 630-210-4205. I'm better at text than voicemail, but leave a voicemail, I'll still call you back.
Yeah. And how quickly do you like to get back to people? Because some loan originators will wait weeks, days.
No, it shouldn't be, and that shouldn't be the case. I'm usually trying to get back to people the same day, unless it's late in the day, then maybe it's the next, or at least I'm shooting you a text and we're setting up a time to chat or something like that. So if you don't hear back from me right away, feel free to get after me again, because it was probably just a mistake on my part.
Great. Well, thank you, Brian, so much. I appreciate you being on the show. Anyone who's interested, please reach out to Brian. So feel free to reach out.
AKA Iron Man, the Iron Man.
AKA the Iron Man of the STR lending world.
Ryan Stark.
Iron Stark. I love that. Before we close out here, I love to ask this question of all guests. You're in the STR space. It could be anything, doesn't necessarily, it could be with finances, whatever. What's the best one tip that you could give people to better cash flow positive?
Better cash flow. Well, honestly, these days, probably more than ever, you might have to spend more to get more, pay more for your pictures, go get the best guy to do your pictures. You might have to pay for the optimization of pricing optimizations, stuff like that, over, amenities in your property, pull the trigger on that extra arcade game or whatever. You just have to step up now a little bit more than you did, maybe a few years ago, when you could just take a few photos with your cell phone, slap it up on Vrbo or Airbnb, and you were rented, 90% occupancy. You got to work a little harder, but there's still tons of people having great success, even in a more difficult time right now.
Absolutely. And I'm seeing it myself, and I know other people are seeing it too. Increases year over year in portfolio performance of STRs, even with market softening or shifting. So, like you said, I love it. Be willing to invest in the property, be willing to invest in your pricing, your strategies into the business. That will help you cash flow positive. Well, thank you so much, Brian, for being on here. I really appreciate it.
And get a loan from me with a really low interest rate. That helps too.
Boom. Well, that's the thing. Like if you do these, if you get it right from the beginning, then it's less stressful to decide what you got to invest in down the road.
Yeah.
Right. So I tell people that all the time. Like, if you bought the right house, you don't have to worry about some of these other things, like competing in a sea of other rentals and all this stuff. So thank you so much, Brian, for being on. This was a treat. Lots of good stuff. Hopefully this helps people understand how they can scale using their finances, and we got over some of the misconceptions in our industry. So thank you so much for being on, and I look forward to seeing everybody else in the next episode.
Awesome. Thanks for having me, Kenny. I appreciate it.